In India, mutual funds are categorized based on their investment objectives, asset class, and structure. Here are the main types. 1. Equity, mutual funds. Objective. These funds primarily invest in stocks, equities of companies. They offer high returns but come with higher risk. Types. Large cap funds. Invest in large, stable companies. Mid-cap funds. Focus on medium-sized companies with potential for growth. Small-cap funds. Invest in smaller companies with high growth potential but greater risk. Sectoral thematic funds. Invest in specific sectors like technology, healthcare, etc. Index funds. Track market indices like Nifty 50 or Sensex. 2. Debt mutual funds. Objective. These funds invest in fixed income securities like government bonds, corporate bonds, and other debt instruments. They are safer than equity funds but offer lower returns. Types. Liquid funds. Invest in short-term instruments, ideal for parking funds temporarily. Corporate bond funds. Invest in corporate bonds. Income funds. Focus on long-term bonds. Dynamic bond funds. Actively manage to adjust the portfolio based on interest rate changes. Gilt funds. Invest only in government securities. 3. Hybrid mutual funds. Objective. These funds invest in a mix of equity and debt to offer a balance of growth and stability. Types. Balanced funds. Invest in both equity and debt in a fixed ratio. Aggressive hybrid funds. Have a higher proportion of equity for growth. Conservative hybrid funds. Focus more on debt with a small portion in equity for stability. Multi-asset allocation funds. Invest in more than 2 asset classes, equity, debt, gold, etc. 4. Money market funds. Objective. These are low-risk, short-term investment options that primarily invest in very short-term debt instruments like treasury bills, certificates of deposit, etc. Types. Includes liquid funds, ultra-short duration funds, etc. 5. Exchange-traded funds, ETFs. Objective. ETFs are mutual funds that are listed and traded on stock exchanges like individual stocks. They usually track indices such as Nifty or Sensex. Types. Index ETFs track specific indices. Gold ETFs invest in gold, providing exposure to the yellow metal. Thematic ETFs invest in a specific theme like technology, infrastructure, etc. 6. Fund of funds, FOFs. Objective. These funds invest in other mutual funds rather than directly in stocks or bonds, offering a diversified portfolio across various asset classes. Types. Domestic fund of funds. Invest in Indian mutual funds. International fund of funds. Invest in foreign mutual funds or global equities. 7. Tax saving funds, ELSS. Objective. These are equity-linked savings schemes that qualify for tax deductions under Section 80C of the Income Tax Act. Key feature. These funds have a mandatory lock-in period of 3 years. 8. Retirement funds. Objective. These funds are designed for long-term retirement planning and invest in a mix of equity and debt to grow the corpus for future retirement needs. Types. Includes NPS, National Pension Scheme, and other retirement-focused mutual funds. 9. International mutual funds. Objective. These funds invest in overseas markets, giving Indian investors exposure to global equities or bonds. Types. Invest in regions like the US, Europe, emerging markets, or sectors like technology. 10. CP-based funds, systematic investment plans. Objective. While not a separate fund type, SIPs are a method